The market whispers stories, doesn't it? Tales of soaring tech giants, inevitable crash, and the next can't-miss opportunity. These narratives, spun from data, hope, and fear, swirl around us, shaping our perceptions and, ultimately, our portfolios. But have you ever stopped to truly question the stories you're being told? We live in an age of information overload, where every headline screams for attention and every pundit claims to have the inside scoop. Yet, amidst this cacophony, independent thinking is becoming a lost art. Skepticism, the cornerstone of intelligent investing, is often drowned out by the roar of the crowd. This video is your shield. It's about equipping you with the tools to dissect the market narratives that dominate the financial landscape. We're not here to tell you what to believe, but rather how to think for yourself, how to sift through the noise, identify the underlying truths, and make investment decisions based on reason, not hype. Benjamin Graham, the father of value investing, wisely observed that the investor's chief problem, even his worst enemy, is likely to be himself. How true. The market rarely defeats us, our own biases and emotional reactions do. And what fuels those biases more than the uncritical acceptance of compelling, yet often misleading, narratives? We become our own worst enemy when we blindly follow the herd, seduced by stories that promise easy riches or stoke our deepest anxieties. So, prepare to challenge the consensus, find your edge, and uncover the hidden truths behind wealth accumulation. Don't just invest, understand the why behind every decision. Let's begin to build a fortress of critical thought, one that protects us from the market's illusions and empowers us to navigate the financial world with clarity and conviction. What if the narratives we cling to are precisely what's holding us back? This time is different. Haven't we all heard that whispered, or perhaps shouted, from the rooftops of Wall Street? It's the siren song of complacency, a seductive melody that lulls investors into a false sense of security. It suggests that the old rules no longer apply, that new technologies or unprecedented economic policies have ushered in an era where valuations don't matter and risk is a relic of the past. But history, that relentless teacher, offers a starkly different lesson. Remember the dot-com bubble. The narrative was that the internet had fundamentally changed everything, that traditional valuation metrics were obsolete. Or the housing crisis. We were told that real estate prices could only go up. In both cases, the "this time is different" mantra fueled irrational exuberance, blinding investors to the unsustainable nature of the boom until the inevitable crash. The truth is, certain economic principles remain constant. Supply and demand, the laws of diminishing returns, and the importance of sound valuation. These are not fleeting trends, but fundamental forces that govern the market. To believe that this time is different is to ignore these immutable laws, to navigate by stars that have already exploded. So, how do we resist this alluring narrative? By building a framework, a checklist of fundamental economic indicators that allows us to assess the sustainability of current market conditions. Look at interest rates, inflation, debt levels, and corporate earnings. These are your compass. They may not tell you exactly where the market is headed in the short term, but they will provide a reliable guide, regardless of the prevailing narrative. Don't let the siren's song lead you astray. What fundamental truths are you ignoring in the pursuit of the next big thing? How often do we seek comfort in the pronouncements of experts? We crave certainty, and the expert consensus offers the illusion of safety in numbers. It's the comforting notion that if enough smart people agree on something, it must be true, right? That the path ahead is clear and the risks are minimal. But let's examine this illusion. Experts, like all of us, are susceptible to biases. Groupthink can stifle dissenting opinions. Career risk aversion can lead to cautious, uninspired forecasts, and even the most brilliant minds can be swept up in the same narratives that grip the broader market. Remember the credit rating agencies before the 2008 financial crisis. They were the experts, and their consensus was that mortgage-backed securities were safe investments. How spectacularly wrong they were. So, how do we avoid the pitfalls of blindly following the expert consensus? By adopting a devil's advocate approach. Actively seek out dissenting viewpoints. Rigorously evaluate the underlying assumptions behind the prevailing wisdom. Ask yourself, what are the incentives at play? What data is being ignored? What are the potential downsides that no one seems to be considering? Warren Buffett, that beacon of contrarian thinking, famously said, "Be fearful when others are greedy, and greedy when others are fearful." This doesn't mean blindly opposing the consensus, but rather cultivating a healthy skepticism, a willingness to challenge assumptions, and the courage to stand apart from the crowd when your own analysis leads you in a different direction. Is the comfort of consensus worth the cost of independent thought? Are you willing to question the experts, even when it's uncomfortable? Passive investing, low fees, instant diversification, and the promise of market-beating returns without the hassle of stock picking. It's a compelling narrative, and for many investors, it's a perfectly reasonable strategy. But is it truly the foolproof path to wealth that it's often portrayed to be? Let's peel back the layers. Passive investing, typically through index funds, comes with hidden risks. Market capitalization weighting, for example, means that your your portfolio is automatically overexposed to the largest and often most overvalued companies. And during market downturns, passive funds offer no downside protection. You're simply along for the ride. Here's a counterintuitive truth. Passive investing relies on active participants to set prices and provide liquidity. The very success of passive investing is contingent on the ongoing activity of informed investors who are actively analyzing companies, assessing valuations, and making buy and sell decisions. Without these active participants, the market would be adrift and passive strategies would quickly unravel. So, how do you ensure that your passive portfolio isn't unknowingly exposing you to excessive risk? Start with a simple ratio, like the price-to-earnings ratio. Take a look at the top holdings in your index fund. Are there companies with valuations that seem stretched, even in the current market environment? Passive investing is like sailing with the tide. It's effortless when the tide is favorable, but disastrous if you lack the skills to navigate against a strong current. Understanding value is your rudder. Are you blindly trusting the tide, or are you prepared to navigate the shifting currents of the market? Our minds, remarkable as they are also prone to systematic errors in thinking, what we call cognitive biases. These biases warp our perception of market narratives, leading us to make irrational investment decisions. Imagine the market as a hall of mirrors, each reflecting a distorted version of reality based on your pre-existing biases. Consider confirmation bias. We tend to seek out information that confirms our existing beliefs, while conveniently ignoring evidence to the contrary. Anchoring bias leads us to over-rely on initial information, even if it's irrelevant or outdated. And loss aversion makes us feel the pain of losses far more strongly than the pleasure of gains, causing us to make rash decisions to avoid short-term losses, even if it jeopardizes our long-term goals. What are your cognitive blind spots? Before making any investment decision, implement a pre-mortem technique. Imagine that the narrative you're embracing proves to be false. What went wrong? What warning signs did you miss? By proactively identifying potential failure scenarios, you can challenge your own biases and make more informed decisions. Financial confidence, decision-making autonomy, and trust in expertise. These are all wounded by the cognitive minefield. Dissect, unpack, debunk, reveal, analyze, empower, master, and navigate market narratives with a renewed sense of clarity and purpose. Are you willing to confront your own biases, or will you continue to be led astray by the distorted reflections in the market's hall of mirrors? What if the key to investment success lies not in predicting the future, but in understanding your own mind? Headlines scream, pundits pontificate, and market narratives swirl, but true investment wisdom lies beyond the surface, in the realm of independent research and critical evaluation of financial data. It's about building a data-driven fortress against the constant barrage of market misinformation. But how do we construct this fortress? Start by learning to access and interpret financial statements, economic reports, and industry analyses. These are the raw materials of informed decision-making. Here's a 3-step technique to discern the genuine underlying mechanisms of the market. First, verify the source. Is the information credible and unbiased? Second, question the assumptions. What underlying assumptions are driving the analysis? Are they reasonable and well supported? Third, stress test the conclusions. What are the potential downsides? What could invalidate the analyst's conclusions? Diligent research can uncover hidden risks or opportunities that are missed by mainstream analysis. These insights can provide a significant edge in the market. The mental healing model, inspired by giants like Benjamin Graham, David Dodd, Philip Fisher, and Daniel Kahneman, provides the blueprint for overcoming cognitive biases and market misinformation. Their work empowers us to approach the market with clarity, objectivity, and a relentless pursuit of truth. Are you willing to put in the work to build your data-driven fortress, or will you remain vulnerable to the whims of the market's narratives? What hidden truths are waiting to be uncovered in the data? We've journeyed through the labyrinth of market narratives, uncovering hidden truths and challenging conventional wisdom. We've seen how the siren song of this time is different can lead us astray, how the illusion of safety in numbers can blind us to hidden risks, and how the oversimplified path of passive investing can expose us to unforeseen vulnerabilities. But more importantly, we've armed ourselves with the tools to navigate this complex landscape. We've embraced independent thinking, data-driven analysis, and a skeptical mindset. We've learned to question assumptions, challenge the consensus, and build a data-driven fortress against market misinformation. Now, the call to action is clear. Apply these tools and techniques to your own investment strategies. Don't passively accept the narratives you're being told. Dig deeper, question everything, and make investment decisions based on reason, not hype. Warren Buffett wisely observed that the stock market is a no-called strike game. You don't have to swing at everything. You can wait for your pitch. Critical thinking allows you to be more selective, to avoid costly mistakes, and to patiently wait for the right opportunities to present themselves. It's about building sustainable wealth, not chasing fleeting trends. Empower the critical investor within you. Cultivate a lifelong commitment to learning, questioning, and adapting. The market will continue to evolve, new narratives will emerge, and new challenges will arise. But with a foundation of critical thinking, you'll be well equipped to navigate any storm and build a future of lasting financial security. What pitch are you waiting for? What narrative will you challenge today?